Good afternoon. I want to thank everybody for calling in today or logging in to the special webinar that we have. Today we're going to talk about a little bit of investing in oil and gas rights and what goes along with that. We're pleased to have Jack Shea here as a guest speaker today who's going to share his expertise on this topic, kind of how you can invest in oil and gas maybe with an IRA or maybe sometimes what makes sense doing it outside an IRA, but just kind of doing a general info session on this type of investment. As we go forward today, if you're somebody who's listening live to the presentation, please type your question into the chat box on your screen. I'd be more than happy to get those questions answered, whether it's for myself on an IRA question or for Jack on the oil and gas. Just type your questions in. If you're watching the recorded version and you have a question that comes up, just jot it down as you go through the webinar. My information, email address will be at the end of the presentation, and I will have Jack's email up there as well, so you can email either one of us with any questions that you have. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm also a licensed attorney, a member of the Florida Bar, although I don't do any legal work for Advanta clients. I've been with the company for a while now. I spend most of my time now doing the education and marketing, hosting live seminars or hosting joint webinars like the one that you're listening to today. Now, a quick disclaimer just on Advanta IRA, what we do or don't do here at Advanta IRA. We do not give legal, tax, or specifically investment advice for any of our clients. If you're looking to use a self-directed IRA, you do need to take that onus is on you that when making an investment or managing your account, that you're getting the proper tax, legal, and investment advice from other parties. Now, we can certainly talk about legal issues. We'll talk about tax issues from time to time, but as far as final determinations, we can refer you to an attorney or a CPA to get those questions answered. And especially as it relates to investment advice and in the context of what we're talking today, we're sharing information today on investing in oil and gas and the pros and cons and things to think about. But as far as determining whether or not that is the right investment for you, please make sure to seek a third party's advice. Today is really just an informational and educational session on the possibilities. Now, a little bit of background on our company, those individuals who are not familiar with Advanta IRA. We've been around since 2004. And the only thing we do at Advanta is the record keeping and administration for self-directed assets. So we don't handle any non-qualified money. So the only funds that we administer are either IRA, Roth IRA, old 401k funds, and holding those as an investment within a particular account. And again, we don't sell any investments. We just provide that service to hold these unique alternatives, and we've been doing that again since 2004. Our focus really is on providing that local service to our clients, whether you're somebody who lives geographically close or not. We give everyone who signs up with us an account manager who will oversee all of the investments and be that person's one point of contact while they are self-directing their retirement account. Now, the types of assets we see within a self-directed IRA, really any type of real estate. If you're buying raw land, rental property, commercial, rehabs, etc., that can all be held within an IRA. Condos, duplexes, it doesn't matter if it has a deed, and as long as it's for investment purposes, you can hold it within your IRA. We also see a number of paper assets, individuals investing in private mortgage loans, unsecured notes, tax liens, doing assignments, accounts receivable, a lot of unique things that individuals have. But the asset itself really is found on a piece of paper. For instance, the pledge to pay on a promissory note or the pledging of a real estate collateral on a mortgage loan. Again, these are more paper assets that we see quite a bit of as well. And we also see a number of other alternatives, individuals investing into private LLCs. Whether it be an LLC that's invested in a partnership, maybe in an oil and gas partnership, as we'll talk about today, or if it's a single-member checkbook LLC, we see that as well. Individuals investing in farm animals, movie projects, precious metals, foreign currency trading, private stock commodities, and as we're going to talk about today, oil and gas rights. Again, there's just a lot of different things that you can hold within a self-directed IRA. In fact, the IRS only prohibits you from investing in life insurance and collectibles. But again, today's webinar that we're going to have Jack Shea here to talk with us about, specifically focusing on oil and gas. And just a few statistics to get us started is from 2013. In 2013, there were over 6.9 billion with a B barrels of petroleum products that were consumed. That equates to over almost 18.9 million barrels per day in 2013. And in 2013 alone, more than 79,000 oil and gas wells were drilled that particular year. Again, as we go through the presentation, if you have questions, please type them into the chat box on your screen. But this time I want to introduce our guest speaker, Jack Shea. Jack was raised in Chicago. He attended the University of Illinois and got his degree in engineering with a minor in business. Jack spent 7 years as an Air Force pilot flying 4-engine transports around the world. And he moved to Florida in 1978. At that time began investing in real estate and notes. He has used trusts in many of his transactions and has partnered with attorney Mark Warda in doing a lot of different trust seminars since the mid-'80s. And Jack has developed several unique strategies that are possible with the use of trust that can give you greater flexibility, privacy, and profit. Jack is also a 1031 exchange intermediary and runs that business with his son Daniel. He's written a best-selling book, The Secrets of Lease Option Profits, and does many seminars a year on doing trusts, options, and checkbook control IRA accounts. You can see his information here on this slide. And at this time, Jack, I want to thank you for coming into the seminar, and I'll turn some of this over to you to tell us what we need to know about oil and gas investing.
Happy to be here, Scott. This is an interesting topic. I have personally invested my own funds in oil and gas royalties and drilling programs. And also as a licensed securities dealer, I've handled millions of dollars worth of other people buying these probably over the last 20 years or so. So it's a broad field, a lot of activity. Where I grew up in Chicago and around here, I didn't know much about oil and gas. Texas and Oklahoma, I've talked to people that they've had these royalties in their family for a couple of generations, so it's common information to a lot of people. But it's oil and gas versus real estate. It has a different life cycle, Scott. It's the curves of real estate and the big sell-off in 07 and 08. The curve of oil and gas prices don't track at all with real estate. They have a different life cycle. So it's kind of a counterplay to real estate as far as cycles go. It has its own cycles, but it's not connected to real estate.
And you find real estate to be kind of a longer cycle typically, and oil and gas can be much shorter term?
Well, they do have their ups and downs on the exchange. You know, we saw recently, of course, the price of oil went from $100 roughly to $50 a barrel. But it also used to be $35 a barrel. So it's had a long, like real estate 25 years ago had tripled probably over those times. So
what are I guess the next slide is the two general categories of people. How can people invest a little bit into oil and gas? What are the two different ways?
They have two excuse me, large categories. The royalty program is a percentage of revenue paid to the landowner or the mineral owners from the production of oil, gas on the property that are required to pay a royalty to the royalty owner, and it's usually a fixed percentage of the gross revenue from the property, and it's after, regardless of the deductions you see on revenue statements. There's a lot of people that get paid in the oil business, all kinds of pipeline people and pumping people and water. It looks like a big HUD-1 closing statement with a lot of people involved. The drilling program is a different kind of program that's not quite suitable for IRA investments, but if you invest $100,000 in a drilling program, you'll get a $100,000 tax deduction in the first 5 years, and a lot of times it's like 85% the first year. So you might get an $85,000 tax deduction. So for non-IRA money, it has a big tax savings, and then you get royalties after. But the royalty programs go on. They go on, and there's, I think, on the lawn of the Los Angeles courthouse, there's an oil well that's been pumping since like 1913.
Wow,
That's neat. And they all don't last that long. But another facet of royalty programs is there's a 15% depletion allowance, which doesn't help in an IRA program, but as an individual investment, it's instead of depreciation, which you get on real estate, which quits after 27 and a half or 30 years with commercial, the depletion allowance lasts forever, goes on for 40 or 50 years. So anyway, those are the two types of things, Scott. One most suitable for IRA owners is the royalty interest.
Well, then in this next slide here, we have kind of the types of interest. So you kind of described the royalty interest we covered. The working interest would be a drilling program.
Yeah.
And then the mineral lease. How would that relate to either an IRA? How would someone invest in oil and gas through mineral lease?
Well,
is that someone actually owning the land and then simply leasing it out to companies that will come in and drill?
Well, people buy land and sell the land, but in the process they keep the mineral rights.
Okay.
And I do a lot of exchanges for guys doing that, and they sort of sell it for what they bought it for. The difference is they've stripped off the mineral leases, so it becomes a saleable revenue stream. So that the types of payments for royalty interests come in a couple different forms, but the net to the IRA investor is the same as the income stream.
Okay.
Legally, it's slightly got a couple of different faces to it. So.
Okay. We had a question come up. We'll see maybe if this is something, Jack, you want to try to address or not. But question came in and says, what will the future of U.S. oil operations hold since Saudi Arabia is now pumping at low prices? Will they continue to do so to eliminate the shale producers? I don't know if you have any thoughts on this. I mean, we're sure not going to hold you to it, but just what are your thoughts in general about that?
In the fracking, in the shale world, and I read what we all can see in the newspaper, and I get some other newsletters, but it's costly. My understanding is it costs close to $50 a barrel to do the fracking kind of stuff. So if the Saudis, but I don't know about the long-term global political situation, but the U.S. is becoming more energy independent, and they may not affect us. So I think oil is not a bad counterplay, even at $50 a share. There's I have stuff crosses my desk. I get solicited by a lot of producers. They're offering 8 to 12% projected annually yield at today's prices. The depletion allowance, there's no debt on these, so there's no leverage. There's no drilling expenses. It's only a matter of market prices, but also these wells have a life cycle. They tend to produce more at the beginning, and then they taper off, and then they rework them, and they go back. So typically in an oil investment, you don't invest in one well. It's typically a pool of like 25 or 30 wells. So some go up and down, they produce more, they rework some. And so your investment is spread across like 25 rental houses instead of one. And
that's a good analogy.
And so you have a share. So the companies, I would we'll talk later about looking at their track record and the promises, and we're talking about the private placement memorandum. That's a couple 100-page book of disclaimers about what goes what they're not responsible for. No promises, essentially.
Right.
No guarantees. So.
Well, when we're talking about these, I mean, obviously the title of the webinar is both oil and gas, and some people tend to be more familiar with the oil aspect just because of the effect it has on us driving our cars every day when oil can spike and cause an increase at the pump. But can you explain a little bit about what is being retrieved? You kind of have the oil production, you have gas production, you have a combination of both. Maybe give us some more insight into that.
Certain areas, guys, sending me information on a new well in the Houston area, which is mostly oil. In other places, they get a large amount of gas, and the gas is valuable, but it's since there's so much of it, the price is down with gas, but they're now liquefying gas. They're putting it in UPS trucks, and it's so the use of liquefied buses and all that. So gas is still a very valuable commodity, and it's hard to pick that you just want to be in gas or you just want to be. They mostly produce both because they're at different levels, and you see all the geology reports that you get. There's gas at some level and there's oil, and sometimes they pass up gas to go for the oil, but in the drilling they know it's there and they can go back and get it. But the bottom line is it's almost all the programs are a combination. You get some maybe 80% oil, 20% gas, or vice versa, but they just rarely have exclusively gas or exclusively oil.
Okay, so if you're looking at investing, if you're going to be investing with a private company, it's probably going to be a standpoint where your returns, your royalty interest might be based on both the oil they recover and also on any gas that they may recover as well.
Yes.
Okay.
Yeah.
All right. When we're talking about investment, just kind of your experience, again, not asking for any particular investment, so to speak, but when people are looking to invest, what are these companies that are looking for either royalty programs or maybe even a drilling program, what are their minimum investments? Again, in your history, speaking from experience, what are they looking for investors?
Well, it's not a few $1,000 deal like a note or a loan or something could be. It's generally $25,000 for 1031 exchange people. It's sometimes $100,000 because they're $100,000 minimum. And sometimes I've asked somebody I knew and they would lower it to less, 50 or 75. But it's not a low dollar investment. But I heard people offering shares as low as $10,000. And so that's the broker-dealer, the people handling the program. But there's a fair amount of paperwork and reporting and checks, monthly checks, so that's not going to be a few $1,000 investment. I would say $25,000 and up is the average.
Right, and again, I guess to remind people on the call and are listening on the recording as well, the types of investments Jack is talking about is not opening up a commodities trading account where you're buying and selling barrels of oil. This is more investing into private enterprises, companies that are going out there and actually doing the drilling and exploration.
A royalty program is existing wells. They're already there, and they're already producing.
Okay.
The drilling program, they drill some holes, except that even the drilling program, they don't go out in the wilderness. They drill between wells they already have. If they have a acreage with 4 wells, they'll drill in the center.
Right.
And they have a lot of geology reports. So it's not exploratory drilling. In fact, the big oil companies, Exxon and these guys, they sell these wells that have been online for a while, and they sell hundreds or thousands of these wells into programs like this, and they take the big money and they go out into the Gulf of Mexico, like the drilling platform, with hundreds of millions of dollars, and they drill that because when they get that, that's a high revenue, or they're in Alaska with those platforms.
Okay.
So that's not something we'd be involved in. So that's why I'll say who is selling these wells. So the big producers are selling them when their revenue is tapered off to this 8 or 10%. They want a higher return. So they'll gather millions and then go do exploratory drilling.
So the bigger players are the ones that are going out there kind of more high risk, high reward, looking for new wells, as opposed to a lot of the private companies that someone might find to invest in are somewhat safer to an extent, and I'm assuming that the royalty program might be something a little more consistent than a drilling program.
Yeah, and a royalty program of 25 wells in over probably in the third or fourth year, they split off a little bit of the revenue and they drill another hole, but you don't pay for it. It's part of the revenue that they hold back, and that keeps the output at a somewhat level pace.
Okay. All right, going to our next slide. Kind of, how would someone who's, you have some people on this call, and obviously people listen on the recording, if you were someone new, kind of where would you look to get started? In which, I mean, obviously they're taking the webinar today and hearing about some of the differences, but where might someone look to get started in investing in either a royalty program or a drilling program?
If you Google it on the web, you'll get 2,500 pages.
Sure.
Yeah.
Sure.
And so I'm not mentioning any names. These people, they solicit me. It's up to the investor to choose. And I would do some homework if people go around, and your stockbroker, if you have one. But they have a couple of people that they handle. They have like Chevrolets, and they're therefore push Chevrolets. That they don't have access to all the programs, and they're different. So it's like any other salesman for Frigidaire or GE or whatever, they push the programs they have. So I would look independently for something that looks interesting, check it out from a couple different angles, and make your own decision.
Well, we have on here to, obviously doing your due diligence is very important. Again, obviously if you're investing through Advanta, we're not doing the due diligence, and sometimes they're investing in these private companies. They're not doing due diligence for you either. They're simply selling themselves. If someone was looking to check on the track record of a particular vendor, what are some things they might want to look for? Are these things that are available publicly for them to look at, or?
Yeah, Scott. The name of this field of 25 wells, and they're closed-end programs. When they're sold out, they're sold out. So it's, say there's 300 investors. We did a 1031 exchange for an oil company about 2 years ago. We did over 300 exchanges in one day because somebody bought the whole oil field.
Okay.
And they took everybody out of it. So this field has a name. It's called Red Bank 14 or something. It's got a name that's of this pool. And that's how it's listed, we'll get to later, for selling it on an exchange. It has a known number of wells and a known track record. So then you ask that company, ABC Royalties, what's the track record of their last 5 years? And they have 6 or 7 programs that they sold in 08 and 9 and 10, and what is that paying and what is it paying now? And the good companies will show you their track record. Some are in the 12 and 14% range, and some are in the 5 and 6% range.
Okay.
And so they will publish their track record.
And are any of these companies, anybody who regulates these companies to make sure their figures are accurate, or are these kind of all usually independent audits that the company pays for?
I think it's a matter of record of what the price was, what the royalties they've sent out to people.
Okay.
Yeah.
All right, let's moving on. If somebody was invested either in a royalty or a drilling program, maybe going through both of those. How does someone get out, so to speak? Especially if you're putting in a substantial sum of money at some point, if you want to pull some of that money out of there, how would you go about doing that?
Well, this is not like GM stock, Scott, where you call up your broker and you've got 500 shares, sell 100 or sell it all, and the next day you get a check. This stuff is not that liquid. And it shouldn't be a short-term investment that somebody going to need the money. I would say long-term IRA investments, or beyond at least a 10-year window of aperture that some people are planning on.
Okay.
Now they are saleable, and first, like any of these tenant in common programs, are sold typically to. There's 3 major candidates. The sponsors will buy back shares in this if it's doing well, and people want their money back or their principal back, and it's yielding 12% or something. The sponsor will buy it, or even maybe, and they may have other people. So the sponsors are candidates. You're able to get in touch with all the other, say, 200 owners, or you can offer, say, I paid X for this 1.7% interest, I would like to sell it, and take offers. Now, if it's some people, I have a friend that's has one of these, and he's found somebody that'll sell him more of a share that the guy wants to get out.
Okay.
And I think he's paying him what he paid for it, and everybody's happy. So other members are candidates. And thirdly, there's that exchange. There's an exchange in Dallas that lists these programs, and there's a bid and offer type of a price. Ask, bid and ask type. And I think they charge about a 3% fee for that. So there's three ways to exit the program, and none of them are guaranteed to exit at a profit unless the program has really exceeded expectations, but people still want to get out or sell for other reasons. They may make a profit on the deal.
And I'm assuming along with that, then so you can't just sell to the general public, because there's probably restrictions within the subscription documents, within the private placement memorandums of what you can do with your shares.
No, you can sell it to anybody.
Oh, you can?
Yes.
Okay.
Yeah, it's in the document. You can sell it to anybody.
All right. What are some risks? Obviously, there's with any investment, you're investing in real estate, you're risking that your tenant doesn't pay or property values plummet, or you're investing in loans and notes that there may not be somebody may not pay you back, you might have adequate collateral. What are the risks involved in investing in oil and gas royalties and drilling programs?
Well, it's all of the above. Risks of getting, the fact that it's not going to disappear, or you had a private loan and the person disappeared or something. This royalty interest exists in some kind of form, but the market forces, like you were talking about, if Saudi Arabia is doing this, or there's more fields discovered and there's great assets, great sources of gas and oil even in the U.S. that haven't been explored.
That, and probably I'm thinking as well, you'd have the risk of the increased productivity, so to speak, or increased with cars, they don't get 10 miles a gallon anymore. We're up to 30, 40, even 50 miles per gallon, obviously causing
and maybe more solar and more wind energy coming online. That's going to make the dependence on these products less. So there's the market risk. There's people that study this. The fracking situation is a bit problematic in that it's now showing up in water wells, or it has for a long time, and secrecy about the chemicals, and so it seems to me that there's going to be greater restrictions on the fracking situation. There's the collection and distribution. You see these train wrecks and these train crashes and blowing up, and they've got 80% of the tank cars are of the old variety, and they should be off the rails according to a lot of people, and they're trying to modify them, but it's a long and expensive process. The pipelines break, they leak, so there's all kinds of hazards and pollution and spills. But so they happen. There have been 4 or 5 recent train crashes, not counting oil trains. But then there's changes in the laws, and some of these tax breaks, like 1031 exchanges, up for elimination, along with the oil depletion allowance and the royalty benefits that the oil industry has. So they're trying to close to raise revenue. all kinds of industry loopholes. And so they consider oil has got a loophole, 1031 exchange is a loophole, agriculture has big loopholes. So Daniel was in Washington last week with the 1031 industry people talking to the Senate Finance Committee in the House about trying to save the 1031. But there's all kinds of potential regulations in Congress, and the lobbies of all these people are screaming about save their, don't gore their dog or
sure.
Yeah. So those are all potential things, Scott. But life goes on.
Yeah, well, I just encourage again. We're kind of getting towards the end of the webinar. If you have questions, please get them typed in. We'll make sure to get them. Just want to go back just one question here on the risk to the investment. You mentioned fracking, obviously causing contamination. Kind of interesting thing about the fracking that I would get your thoughts on is if there were issues that kind of led to a large-scale decrease in fracking, and therefore less oil being recovered by shale, that would seem to then pump up the price of oil. But if your IRA or you personally are invested into a private company that is pulling shale oil, so even as oil is going up in value, your returns might actually be going down because the company you're invested with has been using fracking. Is that the potential concern, or are a lot of these companies spread their oil wells? Some are wells they're fracking, some are more traditional methods.
Now that field, Scott, that pool that anybody would typically be invested in is fairly localized. If it's in Pennsylvania or wherever where they have to use fracking, then that would be more affected than in South Texas where they don't have to use fracking. So it kind of goes with the territory and ups the price and ups the risk. So it's a lot of unknowns like real estate notes or anything else.
Question just did come up that is it correct that an IRA investment is for royalty programs only, not the drilling programs? I think to answer the question maybe is that I think your IRA could invest into either if it wanted to, but I think Jack was saying that the drilling program, there's certain tax benefits that accrue to an individual that would not accrue to an IRA. Is that correct?
Yes, by being able to write off 100% of the investment amount in the first 5 years would probably mean a less of an ongoing income stream, and that a royalty program would possibly be a better choice. But it's not that you're not allowed to invest in a drilling program. You certainly are. If you're investing in a drilling program with your IRA, again, to reiterate, if you're investing in an IRA, the benefit of investing with the IRA is all the income generated is not being taxed when it comes back to the IRA. But on the flip side, you cannot write off or depreciate any assets. If you're investing in real estate with your IRA account, you can receive rents, you can receive profits on the sale back tax deferred, but you don't get to depreciate the asset or take any other deductions. And that's what Jack is saying about the drilling programs, is they offer a large tax deduction for those who are willing to put some capital at risk in those programs, but the deduction is not going to benefit your IRA at all because your IRA cannot take that type of deduction. Before I let you go, Jack, I just want to add, kind of just get a general thought, and again, not holding you to it, but just general thoughts on, is this something, are you seeing more, you think more and more people will be looking into this type of an investment, or is this something that is kind of, or people are skittish about right now with the oil prices? Well, those 79,000 wells that were drilled, we don't know, 14, I think 2014 might have been as many or more, but that's a lot of money poured into drilling, so I think there's enough interest in that, especially because money instruments like treasury bills and money markets don't earn any interest of note that people can live off that or retire off that money. So I still think it's an attractive, well, there are enough people attracted to that with all the vagaries of oil and the unknowns. It's still a very necessary commodity for our economy, and there's going to be a lot that all those numbers about 19 billion barrels a day is not going to drop drastically very soon.
Sure. And another question I had just thought of from the IRA perspective. You mentioned an initial investment can be anywhere from 25 to possibly even $100,000. In your experience with these types of programs, whether royalty or drilling, are there times that the company has a capital call? And the reason I'm asking is a lot of people, for instance, if I had $100,000 in my IRA and I go ahead and I say I'm going to put all of this into a royalty program that's going to give me a 10% return. If the company then that I'm invested in asks for a capital call, my IRA will be the one needing to make that capital call. And you would have to have additional resources within your IRA to meet that, so you don't do anything that's prohibited. Do these companies typically ask for capital calls, or is it kind of you put in what money you have?
No, they don't ask for capital calls. They, even in a royalty program, they have a reserve, as I said, for further drilling or re-drilling, reworking, and to keep the field active and producing. But they don't they do that from revenues that they set aside. Even if the revenues were 5%, they'll still set 20% aside for keeping the field active.
All right, well, Jack, thank you very much for joining us today. Hopefully everybody learned a lot. Again, if you're listening to this on a recording, just all you need to do is write down your questions. You can email it to me. I'll be happy to get those to Jack, or again, Jack can be reached at, what's your phone number, Jack?
727-581-7000, or my website is jackshayrealestate.com. I have some articles or blogs about these exchanges, trusts, and that kind of stuff. So anyway, send me an email or through Scott. Happy to help you out anytime. Yeah,
and again, but Jack is, he's joined us today to share his knowledge on oil and gas. Jack is also very well known in the investor community in dealing with private trusts, lease options, a lot of other great information. Maybe we'll have him back sometime to discuss those as well, but I encourage you to reach out to him. With any questions, you can visit our website at advanceira.com to see other upcoming seminars and webinars. You also find another great deal of information on our site. So, again, we appreciated having Jack here today, just kind of presenting this oil and gas webinar. It's just kind of another unique thing that you can do with a self-directed IRA, looking for a different type of an investment. Some people are familiar, obviously, again, with oil and gas prices. They deal with fill up their car every day. But exploring maybe a little bit more about how you can actually invest into those types of programs. So I encourage you to go to our website for any more information on self-directed IRAs, Google oil and gas partnerships, and hopefully get a lot more information there. So we don't have any other questions, so this time we'll conclude the webinar, and we look forward to having you on again. Thank you.